The silver market has been delivering one of its most dramatic shows in years, and right now, on this Saturday in mid-February 2026, the conversation is electric. Just weeks ago, silver smashed through triple-digit levels, hitting an all-time high near $122 per ounce in late January, before pulling back sharply. Today, the spot price hovers around $78 per ounce, reflecting a volatile retreat from those peaks amid profit-taking, shifting macro expectations, and ongoing industrial pulls. Yet despite this dip on the screen, many dealers and buyers are still facing the same frustrating reality: popular physical products vanishing from shelves almost as quickly as they arrive, lead times stretching out, and premiums behaving as if the price never corrected at all. This apparent contradiction, lower spot yet tighter retail availability, has sparked widespread confusion, rumors of outright shortages, and heated debates about what's really happening behind the scenes. The truth is, the silver market isn't a single unified system reacting instantly to every price tick. It's better understood as interconnected but distinct layers, each moving at its own pace. There's the futures and spot price you see quoted in real time on trading platforms, driven largely by institutional traders, macroeconomic signals, interest rate outlooks, and broad risk sentiment. Then there's the raw metal supply coming from mines, recycling, and above-ground stocks. And finally, there's the retail-ready supply, the coins, rounds, small bars, and fractionals that everyday investors and stackers actually purchase and hold. These segments don't sync up perfectly, and that misalignment is exactly where so much of the current tightness originates. Consider a pattern that's repeated across dealers in recent months. One reliable contact described it vividly: business can flip like a switch, not over months or years, but in mere weeks. During the explosive run-up earlier this year, when silver surged from the $30s into the $100s, sellers flooded shops with metal. People took profits, unsure where the top might be, preferring a sure gain over risking a reversal. Retail buyers, meanwhile, often hesitated at those elevated levels, deciding to wait for a pullback. Wholesalers and refiners grew cautious too, widening spreads and slowing their intake to manage their own exposure in such wild volatility. The result? Dealers ended up with overflowing backrooms, but much of it in formats that weren't flying off the shelves. Then the price corrected sharply, as it has now, into the high $70s, and the psychology inverted almost overnight. Buyers who had been on the sidelines suddenly saw opportunity. This felt like the dip they'd been waiting for, a chance to get in before the next leg higher. Demand surged, particularly for the most popular items, and inventory that seemed abundant vanished rapidly. When the dealer tried to replenish, he hit the next layer of friction: the supply chain for retail fabricated products. Items that once restocked in days now carried multi-week waits, not because mines had stopped producing or vaults had emptied globally, but because mints and private fabricators face real capacity constraints. They can only strike so many coins, pour so many small bars, and package so many rounds in a given period. A sudden wave of orders creates backlogs that take time to clear, especially when price swings keep demand unpredictable. This timing mismatch fuels much of the perceived shortage narrative. A delay of a few weeks might sound minor on paper, but for a buyer who wants product in hand today, it feels like forever. Word spreads quickly through networks and forums: silver's gone again. Yet what's truly bottlenecked is often just the retail-ready form, not the metal itself. Inventory isn't a static pile, it's a constant flow. A single shop or even a region can appear completely sold out, while metal continues moving through wholesalers, refiners, institutional vaults, and private deals elsewhere. It's like glancing at a congested highway off-ramp and concluding the entire city has run out of vehicles. Traffic is still flowing in other lanes, but at that one choke point, everything grinds to a halt. Adding to the complexity is the specific form buyers are chasing right now. Demand has concentrated heavily on smaller denominations: 1-ounce coins and rounds, 5 and 10-ounce bars, fractionals, and even gram-sized pieces that once seemed niche. Larger formats like 100-ounce bars or kilo bricks move far more slowly in retail channels during these volatile periods. The reasoning is straightforward human behavior. When prices climb into elevated territory, a big bar represents a significant commitment enough to trigger second thoughts, family discussions, or budget concerns. Smaller pieces feel more approachable, easier to acquire incrementally, divide, trade, or liquidate if needed. In uncertain times, flexibility wins out over efficiency. Buyers prioritize pieces they can manage psychologically and practically, even if the per-ounce premium is higher. This shift creates a very targeted fabrication bottleneck. Mints like the US Mint, Royal Canadian Mint, or private producers aren't equipped to instantly convert large industrial bars into millions of fresh 1-ounce rounds. That process requires time, labor, design approval in some cases, and allocated production slots. When orders pile up for the small stuff, wait times extend, regardless of how much raw or large bar silver sits in vaults worldwide. Dealers often end up with a mismatch: wait in the back room from walk-ins trading in bigger formats, but empty display cases where customers expect to see the affordable, popular items. Some move those larger bars to other dealers or wholesalers who have demand for them, but conversion back to retail forms isn't immediate. Premiums tell this story clearest of all. On generics like private label rounds or small bars, what used to be modest markups can double or triple during stress. Government-issued coins often see even steeper jumps, sometimes reaching levels that surprise even seasoned buyers. You'll encounter different quotes for the same product depending on whether it's in stock or back-ordered. The dealer factors in replacement risk, potential further volatility, and the cost of holding inventory that might depreciate overnight. This isn't arbitrary, it's calculated survival. Dealers face dual exposures, holding metal that could lose value in a downturn, and promising prices to customers who might cancel if the market swings against them. Recent volatility has amplified stories of buyers locking orders only to disappear when prices move lower, leaving dealers exposed. To counter this, many now require full payment up front, shorten lock periods to hours or a day, or avoid firm quotes until funds clear. It's defensive, not deceptive. Importantly, a visible retail squeeze doesn't automatically translate to a global physical exhaustion. The market can experience acute distribution and manufacturing frictions without running dry overall. Industrial demand provides a steady baseline here. Silver consumed in electronics, solar panels, medical devices, EVs, and emerging tech like AI data centers doesn't vanish when prices fluctuate. Manufacturers often buy regardless, locked into production schedules, though some thrift usage or substitute where possible. In 2026, industrial fabrication is projected around 650 million ounces, down slightly from peaks due to efficiency gains in solar, but still massive, supported by grid expansions, electrification, and tech growth. Mine supply, largely a byproduct of copper, lead, zinc, and gold operations, grows modestly, expected up about 1% this year to around 820 million ounces, while recycling rises with higher prices, potentially exceeding 200 million ounces. Total supply may hit a decade high near 1.05 billion ounces, yet structural deficits persist for a sixth straight year, around 67 million ounces projected, as investment demand offsets industrial softness. This backdrop means retail waves hit a system already running lean. When spot corrects but buyers rush in, the retail pipeline narrower and slower, strains visibly. Premium gaps widen between in-stock and future delivery. Online quotes diverge from local shops depending on who's holding what, and policies tighten to manage risk. Volatility itself acts as fuel. Rapid swings make every promise costlier, every delay more noticeable. Yet these episodes also reveal deeper truths about demand resilience and supply flexibility. Retail interest remains robust, especially for smaller liquid units, signaling preparation for uncertainty rather than speculation alone. Fractionals gain traction for their divisibility, though their higher per ounce costs demand caution. Premiums scale inversely with size, much like tiny water bottles costing more than large jugs. If silver sustains higher averages, buyer preferences could shift again, with even 10-ounce bars feeling substantial relative to incomes or budgets. That same behavioral flexibility explains why certain products vanish first and fastest. In the heat of a buying wave, people gravitate toward what feels safest and most controllable. Small, recognizable liquid pieces they can hold, count, divide, or sell without second-guessing. A 100-ounce bar might offer better metal to premium economics in calm times, but when uncertainty spikes, it becomes a commitment that requires more conviction. Smaller units lower the psychological barrier to entry. They let buyers scale in gradually, test the waters, or adjust quickly if sentiment shifts. This isn't irrational, it's adaptive. And because mints and fabricators allocate production capacity months in advance, a sudden pivot in buyer preference toward fractionals and singles creates exactly the kind of targeted scarcity we're seeing now. Large bars may still sit quietly in dealer vaults or move quietly between wholesalers, but the display cases that matter to walk-in customers look barren. Dealers navigate this mismatch daily. Many have told similar stories. Customers walk in asking for American Silver Eagles, Canadian Maple Leafs, or generic 1-ounce rounds, see empty trays, and assume the entire market has dried up. Meanwhile, the dealer might have thousands of ounces on hand, just not in the form being requested. Converting large bars into retail product isn't a quick flip. It involves shipping to a refiner or mint partner, paying fabrication fees, waiting through production queues, and absorbing the risk that demand could evaporate before the new inventory arrives. In a market swinging $5 or $10 in a single session, that risk feels enormous. So dealers often choose to offload larger formats to other channels where they're wanted, rather than sit on them hoping retail tastes change. From the outside, that can look like hoarding or withholding, but it's usually just efficient inventory rotation. This brings us to one of the most counterintuitive parts of the current environment: why premiums are climbing even as the spot price has pulled back into the $70s. Many expect that a lower spot should automatically mean cheaper physical silver. In stable conditions, that logic holds. But when volatility is high and replenishment is slow, premiums become a function of far more than just the underlying metal cost. They reflect replacement risk, carrying costs, labor, shipping delays, fabrication backlogs, and the very real possibility that the dealer might not be able to refill the shelf at anything close to today's price. If a dealer sells the last tube of Eagles at a $4 premium over spot, and then has to wait 6 weeks to replace it, during which spot could rally back $15, the effective cost of that transaction turns negative. To protect against that, premiums widen. Backordered items often carry higher quotes than in-stock pieces because the dealer is building in a buffer for where replacement might land. It's not opportunism, it's arithmetic. Dealers also tighten purchase policies for good reason. Volatility breeds flakiness. Buyers lock in prices during a dip, then vanish if the market rebounds before funds clear or delivery occurs. One dealer shared that he's seen more order cancellations in the past few months than in the previous 2 years combined. Each cancellation leaves him exposed, potentially having bought metal at a higher price to fulfill a now-dead deal. To counter this, many now insist on immediate full payment, limit price locks to same-day or even same-hour windows, or simply refuse to quote firm numbers until payment is verified. These rules feel strict to new buyers accustomed to e-commerce convenience, but they're standard risk management in a market moving this fast. The dealer isn't trying to frustrate customers, he's trying to stay in business. Zooming out, it's crucial to separate retail tightness from global depletion. The silver market can and often does experience acute retail bottlenecks without the planet running out of metal. Above-ground stocks remain substantial, estimated in the low billions of ounces when including exchange vaults, industrial inventories, ETF holdings, and private accumulations. Much of that metal isn't immediately accessible to retail channels. It's locked in institutional arrangements, committed to long-term industrial contracts, or held in forms that require significant processing to become coins or small bars. The retail segment is a narrow pipe fed by a much larger reservoir. When demand surges through that pipe, pressure builds quickly, even if the reservoir itself is deep. Industrial consumption adds another stabilizing layer. Unlike retail investors who can pause during high prices or wait for dips, manufacturers often cannot. Silver is embedded in photovoltaic cells, multi-layer ceramic capacitors, conductive pastes, medical imaging equipment, water purification systems, and a growing array of 5G and AI-related components. Global industrial fabrication demand is expected to remain near record levels in 2026, even with some efficiency improvements in solar reducing per-unit usage. These buyers purchase steadily, frequently on longer-term contracts, providing a reliable floor under the physical market. When retail demand spikes on top of that baseline, the system flexes, but not always smoothly. Supply-side dynamics reinforce the tightness. Roughly 70% of mined silver emerges as a byproduct of copper, zinc, lead, and gold operations. Primary silver mines exist, but they represent a minority of output. If base metal economics weaken, say from slower Chinese industrial activity or softer commodity prices, byproduct silver production can stagnate or decline, even as silver itself rallies. New mine development takes 5 to 10 years from discovery to production, so short-term price signals don't quickly translate into new ounces. Recycling helps close the gap, rising sharply when prices climb, but recycled material typically returns as doré or bullion bars, not ready to sell retail products. That still requires fabrication, adding another step to the chain. The net effect is a market that structurally runs deficits in most years. The Silver Institute's most recent data shows global demand outpacing mine supply plus recycling by tens of millions of ounces annually for several consecutive years. Investment demand, bars, coins, metals, and retail rounds fluctuates the most, but when it surges, it amplifies existing strains. That's precisely what we've witnessed in recent months. A sharp correction in spot price triggered a rush of bargain hunters, overwhelming a retail fabrication channel already stretched by sustained industrial offtake. Premium behavior offers the clearest real-time signal of this stress. On widely available generics, markups that once hovered $2, $3 over spot can push $5, $8 or higher during peaks. Sovereign coins frequently command even steeper premiums, sometimes $10, $15 or more on popular issues. You'll see stark differences between in-stock pricing and backorder quotes, between online dealers with deep inventory and local shops running lean, between those willing to risk firm quotes and those who won't commit until the wire hits. These variations aren't random, they map directly to each seller's exposure, backlog, and confidence in restocking. Volatility itself acts as an accelerant. When spot can move several dollars intraday, every transaction carries embedded optionality. A buyer who locks a price effectively holds a short-term call option. If the market rises, they keep the deal. If it falls, they can walk. Dealers aware of this asymmetry price accordingly or restrict terms. The result is a more cautious, less fluid retail market than most casual observers expect. Despite these frictions, the underlying demand picture remains robust. Retail buyers continue prioritizing smaller, more divisible formats, reflecting a mindset geared toward flexibility and resilience rather than pure speculation. Interest in fractionals, half-ounce, quarter-ounce, 1/10-ounce coins, gram bars has grown noticeably, offering portability and ease of use but at materially higher per-ounce costs. The smaller the unit, the larger the fabrication burden relative to metal value, much like buying single-serve bottled water versus a gallon jug. Fractionals make sense for specific goals, bartering scenarios, gifting, incremental stacking, but they're rarely the lowest-cost way to accumulate ounces. Looking ahead, buyer preferences could evolve again if silver sustains higher nominal levels for an extended period. A 10-ounce bar that feels modest at $30 per ounce might feel substantial if silver averages $80. $100 in incomes don't keep pace. In that environment, even mid-sized bars could start behaving like big formats, pushing demand further down the size curve and intensifying competition for the smallest pieces. Coin shows and major regional events serve as another vivid pressure test for the entire retail ecosystem. When a large show arrives in a city, it concentrates hundreds or thousands of buyers, collectors hunting specific dates, new stackers looking for their first ounces, seasoned investors reallocating, everyone under one roof. Dealers bring their best inventory, but the small denomination silver often disappears within hours. Buyers want tangible product they can inspect, bag, and walk out with immediately. Pre-orders, waitlists, and multi-week shipping windows lose their appeal when the alternative is holding something real right now. That immediacy creates mini surges that clear tables fast. Dealers who arrive prepared sometimes sell through entire allocations of popular 1-ounce coins or 10-ounce bars before lunch. The pattern repeats. Hesitation turns into regret when a buyer passes on a tube, circles back later and finds it gone. That single moment of "I should have grabbed it" fuels even stronger urgency the next time prices dip or a show rolls through. It's not just economics at play. It's the powerful human driver of regret avoidance. As premiums climb on silver, some buyers naturally start exploring alternatives, and copper often enters the conversation. Retail interest in copper rounds, bars, and novelty pieces has spiked noticeably in recent months, with certain shops reporting they can't keep popular copper products in stock. The appeal is understandable. Copper carries strong industrial fundamentals tied to the same electrification and infrastructure themes, boosting silver grids, data centers, EVs, renewable buildouts. Yet the retail reality differs sharply from the macro story. Most copper rounds sold to individual buyers are not pure investment vehicles. They're fabricated collectibles carrying significant markups for design, minting, packaging, and dealer overhead. Copper's density makes it heavy and expensive to ship relative to its metal value. So paying a large premium per ounce means you're largely stacking fabrication costs rather than raw commodity exposure. Dealers acknowledge the demand is genuine, but many remain cautious, viewing heavy retail copper stacking as more of a novelty trend than a durable wealth preservation play. If the goal is exposure to copper's industrial upside, tracking futures, ETFs, mining equities, or related themes through more efficient vehicles often makes more sense than paying retail premiums for physical rounds. The distinction matters. Strong fundamentals don't automatically justify high-premium physical accumulation. Returning to silver, the central question hanging over the market right now is duration. How long can these retail bottlenecks and elevated premiums persist? The honest answer is that no one can pinpoint the exact timeline with certainty. The outcome hinges on two primary variables that remain fluid. First is the level of price volatility. When spot stabilizes even at higher averages, dealers gain confidence to restock more aggressively, buyers relax their rush mentality, and premiums tend to compress as replacement becomes more predictable. Prolonged wild swings keep everyone defensive. Dealers widen spreads and shorten lock times, buyers stay jumpy and chase dips harder, and the friction in the system lingers. The second variable is production capacity and backlog clearance. If mints, private fabricators, and refiners can work through current order queues and restore shorter lead times, the retail pipeline unclogs gradually. If demand waves continue arriving faster than production can ramp, bottlenecks remain sticky. Remember that even when raw silver or large bars are readily available, transforming them into the precise coins, rounds, and small bars people want is a manufacturing process with real constraints. Design approvals, die preparation, pouring schedules, quality checks, packaging. None of it happens instantly. Practical observations from buyers across different regions reveal telling patterns. Government-issued coins frequently carry the steepest premiums, especially on popular issues like Silver Eagles, Maples, or Philharmonics, because their brand recognition and liquidity make them the default choice during uncertainty. Generic rounds and bars often see more moderate markups, though even those can jump significantly when backlogs grow. In-stock items at local shops or online dealers with deep inventory can trade at noticeably lower premiums than back-ordered equivalents, where quotes build in extra cushion for future replacement costs. These gaps provide useful signals. Widening differences between in-stock and future delivery pricing indicate ongoing strain, while narrowing gaps suggest easing pressure. For anyone newer to physical precious metals, high premiums can feel alarming, but they don't automatically mean you should rush to buy at any price. Patience often proves valuable. Sometimes the smartest move is waiting for a calmer window when restocking catches up and markups moderate. Other times it means pivoting to different products, perhaps larger bars if they're available at better relative prices, or spreading purchases over time instead of chasing a single large order during peak frenzy. The trap many fall into is paying peak premiums in the heat of a rush, only to watch the market normalize later and feel the sting of overpaying. Staying disciplined, buying consistently rather than impulsively, and focusing on long-term cost basis rather than short-term headlines tends to serve accumulators better over time. Stepping back, the current environment boils down to a clear sequence of cause and effect. A sharp pullback in the spot price woke up sideline buyers who had been waiting for a better entry. That surge overwhelmed the retail fabrication channel, which is narrow, slow to scale, and heavily skewed towards small, popular denominations that are hardest to replenish quickly. Premiums rose not because silver globally disappeared, but because replacement risk spiked, pipelines jammed, and dealers had to protect themselves against violent swings and order flakiness. Policies tightened accordingly. Shorter locks, upfront payment requirements, firmer terms, because in this kind of market, loose promises can become expensive liabilities. And yet the entire setup can reverse just as rapidly. When sentiment shifts, when volatility cools, when production catches its breath, shelves refill, premiums ease, and the sense of scarcity evaporates almost as quickly as it appeared. What deserves close attention moving forward is the evolution of a few key indicators. Track lead times on popular items. Shortening waits signal relief, while persistent or lengthening delays point to continued strain. Watch the premium spread between in-stock and back-ordered product. Convergence often precedes broader normalization. Observe whether buyer focus remains locked on small units or begins drifting back toward larger bars as prices stabilize and confidence grows. And above all, monitor volatility itself. It is the single biggest accelerant. Sharp, sustained swings keep the system on edge. Calmer ranges allow it to breathe. The deeper lesson these episodes repeatedly teach is that the most advantageous silver is often the calm silver. When headlines are quiet, when premiums are modest, when restocking is routine, accumulation tends to happen at far better levels. The next dip arrives. Buyers who learned from previous cycles move quickly. Inventory clears before most people even register the move, and the market ratchets higher in steps. That dynamic jolts of demand followed by pauses, then new surges explains why retail tightness can appear and vanish so abruptly, even when the broader supply-demand balance isn't drastically changing overnight. In the end, this is a market shaped by human behavior as much as by mining output or industrial consumption. Screen prices dance to macro music rates, inflation expectations, currency moves, risk appetite, while the physical retail channel responds to something slower and more visceral. Individual decisions to act, to wait, to protect, to accumulate. Those two speeds don't always align, and right now they're dramatically out of sync. Understanding that disconnect is what separates confusion from clarity. Silver hasn't vanished. The pipeline is simply stressed. The psychology is amplified. And the system is reminding everyone that physical ownership in volatile times is never as seamless as clicking a futures contract. Stay observant, stay patient, and recognize that these windows of friction often precede the periods when the market rewards those who prepared calmly rather than chased frantically. This breakdown is offered purely for education and information. It reflects how the market appears to function based on current flows, dealer feedback, and available data. No buy or sell recommendations. No guarantees, no crystal ball. Every decision rests on your own research, your own risk tolerance, and ideally conversations with qualified professionals who understand your full situation. Markets evolve quickly, and what holds true today can shift tomorrow. Navigate thoughtfully,